Welcome, everybody. It's just past 7 here on the West Coast, 10 o'clock on the East Coast on January 7th, 2026. Hard to say that. And we've got Robert, Charlie, Nadine. You know the characters. I don't even need to give you the last names here. Talking about markets, they asked us to save what could be a potential debate here. So I was going to start with Robert, but now I'm going to start with Charlie. Charlie,
No. Start with Robert.
You want to go with Robert? All right, Robert. Great year, a lot of great picks.
I don't care. Yeah.
But as you know, we have to clean the slate every year, every day to figure out what are we doing next. So what's on your mind today?
Well, what have I done for you lately, right? So
exactly. Well, I know. I made all this money in European defense last year. I trimmed it. I've got smaller positions now, but I think I'm going to exit and go into some more boring industrials over in Europe. So you gotta always reinvent. You can't just be sticking around on your laurels. So what are you going to do?
So I bought a stock today. I bought a stock this morning before we started the show. Right?
Look at you.
And I've talked about it in the past. It's a nano micro cap, but it's my commitment to this show is to share with people what I do in real time, and that's what I'm doing. I'm not buying Google to say I bought Google, So company's called Intest. INTT is it's an industrial and semi cap equipment and processing equipment, test and measurement kind of conglomerate. It's 8 and change today. My position has been established in the last couple months at around $7.17. I've traded this very well in the past. About 5 years ago, I bought a large position at 6 and change, and I sold it between 16 and 25.
What do these guys do?
They make test and measurement equipment for the semiconductor business and the automotive business. Electronic test and measurement equipment. And
so what's the thesis?
So the thesis is there's two really different kinds of semiconductors. There's there's analog, mixed signal, power, industrial in one group, in one bucket, and then there's another bucket that has all that's a crappy bucket right now. The other bucket is logic, which is processing units, and memory, like DRAM and NAND flash. And these guys don't have a lot of customers in the sexy space. However, they've had a huge down cycle in the space they're in. And it's been about a 2-year down cycle. And these guys made over $1.20 about 3 years ago. And if assuming that the down cycle is over after 2 years, and you look towards this year and next year, I really think they can make over $1 a share. If not, this year, at least on a run rate basis, exit the year at $1, and maybe next year do $1.25. So 20 on that is a triple in the stock, back to where I sold it a couple of years ago. So
what's
it's
the
down.
Again?
INTT, and the name is Intest, one word. Small.
Oh yeah, I know them. Sorry, I didn't know them. Yeah.
Small INTEST, and it's based here in Jersey. I know the management team. I think they're solid. There's net cash on the balance sheet. There's no debt. So the balance sheet is in excellent shape, and they're just waiting. What the CEO has talked about publicly is his upper level funnel of proposals, because these guys do a lot of semi-custom engineered products, is at the highest level ever by a lot, not just like 5 or 10%. So capital investment has to happen in the semiconductor space and in the automotive space for that.
And it's just here in the US or globally? Do they have global customers?
Oh, no, their customers are very global because they service the semiconductor business, and that's a global business.
Yeah.
But I think there are signs that in a year the business will have recovered strongly, and they'll be back to the mid-teens if they're making $1 run. Now they have 2 or 3 competitors, and all of those stocks have doubled off the bottom. And these guys are $2 from the bottom. The bottom was 6 and change. The stock's 8.
Please. Yeah.
They have a lot of catch-up side. and they're only about 0.75 times EV to sales. And we're in a 3.25 EV to sales market. I have not pitched a stock at under 1 time sales that didn't work, including two worked and then unfortunately lost their workings, which would have been Ceragon and Select Water. So you have very limited downside from a valuation for the business. And we're just waiting for the cycle to turn on. The company's peers the stock prices have been discounting the recovery, whereas these guys, because they're sort of obscure, they've lagged.
Yeah. Okay. Well, it sounds interesting here. Let's see. When do you think, like, what are we looking for to know if the thesis is working or not? Like, how long do you have to wait for this thing?
Well, they report the December quarter, right, in a month and change, couple 6 weeks. So there should be an outlook for 2026. The street numbers, I'm way above the street numbers, and I don't mean 20 or 30%, but 5 to 10%, I'd be on the sales. And if they get 5 to 10% better sales than the street estimate, they would leverage that and they would be able to to have a financial target.
So it's soon. You're saying it's soon here that you're not waiting like 9 months.
No, I mean, I've been out of this for a year and a half waiting to get back in. And you guys know I don't like to do turnarounds because they take a lot longer than everybody thinks.
Yeah.
Okay. So I'm not a fan of just buying something because in 3 years it should double or triple.
Yeah. Yeah.
I'm only buying this from nothing to, a few percent position long in my portfolio because I'm buying this now because I believe the visibility to the turnaround will in the next 2 to 3 quarters. If not the outlook for 2026.
Okay. All right. Fair place here. Well, thank you for that. Charlie, what are you looking at?
I'm looking at Jefferies. They report earnings tonight after the close, symbol JEF. And the reason that they're important is because they give you some sort of insight into the capital markets momentum that the big banks will start reporting next week. So big bank earnings start next Tuesday with JP Morgan. But tonight we get sort of a preview of what's going on in trading and investment banking, when Jefferies reports. So if you think about it, banks have two major buckets of revenue. There's top line revenue, is what we call net interest income or spread income. There's fee income, and the primary driver of fee income for the big banks are capital markets, things like trading and investment banking and wealth management. And Jeff is going to give us a clue as to how strong those are and give us some insights as to what the pipeline looks like going forward. So, Jen, if you can put up the first table.
And those, just so people know, I mean, because you haven't mentioned it yet, why they've been hit this year. So maybe explain that, right?
Yeah. So Jefferies has an asset management arm that was involved in First Brands. And they had an outsized exposure to First Brands when it went bankrupt. And so there have been questions about, is there a conflict of interest between their underwriting group and the asset management operation? Right. Why did they have such a big outsized, position and exposure? Right. We addressed that in October by saying we don't expect it to have a major financial impact on our results, but it could have a reputational impact. And that's the second we're going to want to watch, unique to Jefferies, as to whether it had a reputational impact on their asset management operation. But that's unique to Jefferies. And so I was just really talking about the things that Jefferies is going to highlight today.
But, you're talking about Jefferies, so I got to bring it up.
No, it's a good question, because there are issues around, uncertainties around credit. I think they're good. The commentary we're going to get next week from the big banks is that credit's not an issue, but there are issues, and Jefferies was one of the people that got caught with First Brands. So it's a good question. But Jen, can you put up the first table? All right, so this is the fourth quarter expectations for Jefferies. The thing to keep in mind here is Jefferies is on a fourth quarter that starts with September, October, and ends with November. So it does not have December in it, whereas next week, the big banks will report October, November, and December quarters. And the importance there is September was a very strong quarter, And October and November were affected by the government shutdown, so you couldn't get IPOs approved, or the FTC was shut down, so you couldn't get M&A approved. But December was a return to normalcy, but it had the holidays. So if you think about it, September was a very strong seasonal month. December is probably a weak seasonal month because of the holidays. So Jefferies is going to give you sort of like the ceiling of what you could expect from the big banks, if that makes sense. Listen, no one's buying or selling, stocks based on fourth quarter data. They're going to buy it based on what the momentum is coming into the new year. And that's what we're going to listen for. So let me just point out a few things. So on the advisory side, which is the top, right salmon colored box, M&A advisory revenues are supposed to be up 9%, which, is fairly weak. I think you're going to see, double digit type of numbers in 2026 because there's some big deals coming in through the pipeline. Equity and debt underwriting were very strong. So that's the next two salmon colored boxes on the right-hand side. And then total investment banking was up 20.1%, according to our estimates. So, and so you're going to get some fairly strong investment banking revenues out of Jefferies. And that's important because investment banking revenues are considered a higher quality source of revenues versus trading, where trading is very volatile and unpredictable. And so people will pay up for investment banking revenues, whereas they will not pay up for trading. Now,
can I ask you a question on that? Can I put a pin in that for a second? So obviously some of this was, they're brought in months before a deal, right? If not quarters. And how will you really know when there's reputational risk? Like, could you have a really good quarter now, but then it falls off a cliff because people who had considered them before aren't considering them? Like, is that a risk here, or how does the flow of that business cycle work?
Yeah, I think you're right in saying we have to wait for a lag before we really understand it. They're going to make a case that, that it didn't hurt them in the fourth quarter, but I think it's too early to draw that conclusion. But we'll see. It could have hurt their, asset management operations and not their underwriting operations. But, there are concerns about conflicts of interest at Jefferies. So, and what's going to be hard is the pipe. I'm expecting they're going to talk about a very robust pipeline and backlog. And so it's hard, when you get a pickup in activity in that area, even if they are losing some market share, they're still going to have strong numbers. So that's going to be the hard parse out. Go back to Jeffrey's table, Jen. There's one last thing I just want to make about their numbers So the bottom right, I have three salmon colored boxes that deal with trading. Equity trading up 7.7%, FIC trading up, flat, and total trading up mid-single digits. That's important to understand. I'm making the case that we are in the mature phase of capital markets. Now, mature phase doesn't mean it can't be very robust in 2026. Yeah. I think it's likely to be peak revenues for capital markets. And some of the things that happen around peak revenues is you get this transition from FIC, with FIC stands for fixed income, commodities, and currencies, as the driver of revenue, to equity and M&A as the driver of revenues. And I think that's going to be the theme that we're going to see in the fourth quarter, is that equity and M&A are the bigger drivers of total capital markets revenues, and fixed income is less of a driver. That transition usually marks a mature phase, and I'm of the belief that we're going to see peak revenues in 2026 in capital markets. So the question becomes, what do you want to pay for that? And as a value player, I'm not willing to pay much for that. Momentum players play it right through, the peak reported revenues. And the revenues in the, first quarter of 26 from capital markets are likely to be very, very strong, given that the fourth quarter was delayed on the underwriting side and M&A side by the government shutdown. So all those deals that got delayed are going to get pushed into the first quarter. So I think we're going to have an incredibly robust first quarter. So let's talk about how, some of these Jefferies numbers and how it's going to impact the big banks. Let's go to the next table. So these are my fourth quarter expectations for the big banks: Goldman Sachs, Morgan Stanley, JP Morgan, Bank of Citi. And total capital markets revenues on a year-over-year basis should be up high single digits. That's that top, table. The middle table shows trading revenues up, roughly mid-single digits. And again, it'll be more equity related trading than FIC related trading. And then the bottom table will show, double digit type of revenue growth. And that's what, that's the kind of growth that people are going to pay up for, is that double digit investment banking. So I expect the stocks, which have anticipated a lot of this, will still do well in the first quarter of the year because of that robust pipeline in investment banking. Just some rough rules to understand why I think investment banking is also at a peak level. The rule of thumb is that M&A peaks around 4 to 5% of market capitalization and 5 to 6% of GDP. So if we have global market capitalization of 125 trillion and we have GDP globally of 117 trillion, then you can talk about this, what we saw in 25 as being somewhere around 4, maybe 4+%, those numbers. So we're getting close to where they things typically peak as a percentage of global GDP and global market cap. So let me give you some numbers. In 2025, we did M&A globally of 4.5 trillion. So that's 3.8% of GDP globally and 3.6% of market cap globally. So we're not at peaks, but we're closer to peaks. And then if you look at the third quarter of 25, which was a really robust quarter for M&A, we had 1.3 trillion in the quarter, which annualizes to 5.2 trillion. So 5.2 trillion now gets you to 4.4% of GDP and 4.2% of market cap. So we're getting closer to what are typically peak levels.
But what about like the average transaction size? Like, because you could look at all of the PE names that haven't had liquidity, right? So is the average dollar going up versus the number of deals, or is the number of deals going up and they're just smaller? Maybe kind of walk through if you know any of the trends there, because my concern about just taking the aggregate number is like, what's the story below that?
You are anticipating my next. You are very smart.
Oh, sorry. Well, no, I just, I grew up as an analyst. I was a measly analyst in the 90s. You have to ask why, right? Otherwise you'll get hit over the head.
So that's
literally and figuratively.
So that is the next thing that we look for to understand whether we're in the mature phase. Usually in the very later stages of an M&A boom, you get what we call mega deals. Mega deals are defined as deals over 10 billion in size. And we had a record number of mega deals last year. So believe it or not, we didn't have a lot of small and middle market M&A deals. And that made it tough for private equity and private credit to liquidate and monetize their portfolio. So they're still hurting for liquidity, the private equity, private credit guys. It was the big deals that, like Norfolk Southern, what was it, Electronic Arts, those type of deals are the deals really characterized last year. And I suspect that that's going to continue, that the mega deals are going to be what really drives the M&A market. And that is very typical of a mature phase of a capital market cycle.
Yeah. Okay. But so one could argue though, right? Oh yeah, but AI, it's just big numbers. So how much of that was AI related versus non-AI related? Is there, if you kind of looked at the steady state of other deals versus kind of crazy AI deals, what do you get?
Oh no, there were a lot of mega deals outside of AI. I'm trying to remember them, but I can't remember off the top of my head. I mean, I remember Norfolk Southern because I know Wells Fargo was that, and that was unusual because they have not been considered one of the top 5, and to have captured that. Goldman Sachs, I think, made $100 million on one of their big mega deals.
Yeah,
that will get booked in the first quarter. So there's a pipeline.
Yeah, Google bought Wiz. Yeah, there was Chevron, Hess, Rio Tinto, right? There was, well, I guess
so
Paramount.
It wasn't AI related. That I can assure you. I just can't remember all the deals off the top. But yeah, I mean, so we are going to have tremendous momentum, and I think that's the takeaway from Jefferies coming into the first half of this year. And I expect, while 2026, to give you an idea of numbers, in 2021, investment banking for the Big Five generated about $53 billion of revenues. This past year, 2025, had about 38 billion of revenues. The street right now is expecting about 42 billion of revenues in 26. And I think it's going to be higher than that. I think the investment banking revenues are going to be a positive surprise. On the other side, trading revenues are probably going to be a negative surprise. The street has trading revenues, up, low single digits. I think they're going to be down mid-single digits. And so, when you look at that mix, trading down, investment banking up big, that's positive for the multiples of these stocks. But then you look at these stocks, and JP Morgan's trading at 3 times tangible book, Morgan Stanley at 3 times tangible. They're anticipating a lot of this. So I can't get excited about buying these stocks here. I'm more of a seller on strength. And I hope to be short by February, March, a lot of these names, because I think it'll be peak momentum.
Okay. I think I'm with you there. And so on these names you said, so you talked about Jefferies in particular, but would you be doing short on individual names, or would you be just going through the XLF, or what would you do at that point? Are you just looking more for valuations and picking them off that way? So if someone wants to get prepared, what should they do?
Yeah, the answer is I am willing to short individual names. I'm not going to do it, into the teeth of earnings or coming out of earnings. I'll probably wait for that to die down. There are a couple of banking conferences in March. I probably will, sort of listen to the sentiment going into that, and that would be sort of the timing of when I might, look at the short side of these things. And then, you can differentiate, between those that benefit from strictly corporate, activity. Like a Bank of America really doesn't deal a lot with the hedge fund community or the macro traders. They more with the corporation. And so they have a steadier, predictable stream of investment banking revenues. Whereas at JP Morgan and Goldman Sachs, can be a lot more volatile depending on how the macro and hedge fund, traders play. So you have to understand, whether they're having good years, bad years, how they're positioned to make those distinctions.
Okay. All right. Well, thank you. And if people just want freebies, I'll give a random freebie before we exit here. India has been kind of unloved, so it's not quite yet at the place where I would enter. In fact, I just had my screen on. Where'd it go here? But I was just taking a look at where would you can get it through the ETF INDA if you don't do local stuff, especially there, which is kind of a different ball of wax. But if you want to take a look at India, which is one of the few less loved EMs of last year, I'd be looking at it at 53.64 on the low end as a potential buy. And right now it's about, call it 54 and change. So it has to go down by a little bit, but that is something if people want a freebie. It has nothing to do with anything that Robert or Charlie talked about today. You want to diversify somewhere totally else. I won't go into all the fundamentals around that, but, and a simple thesis is that we expect that the trade situation isn't as bad as they think. The country will do better than people think. It has been unloved. And so if you're looking for a little bit of value internationally, we would look there. So thank you, Robert.
It might figure into what I was talking about, because isn't India supposed to have a big IPO year this year or something like that?
They might. Yeah, they might. You're right. There you go. Connecting the dots as always, Charlie. So thank you, everybody. Again, it is January 7th, 2026. We have Charlie Peabody, Robert Marson, Nadine Turman here for you for Wall Street Beats, powered by Passes. Thank you so much.
Thanks, Nadine. Thanks, Robert.
Bye-bye.
Excellent.
Thanks, Jen.